So today, the stock market's fear gauge dropped 4%, while the global price of oil spiked 4%.
Right, which is wild because usually those two metrics move in absolute lockstep.
Exactly. When they violently divorce like this, it tells us that someone on Wall Street is, well, catastrophically wrong.
Yeah, somebody is definitely mispricing reality right now.
Welcome to today's deep dive. We are unpacking a massive stack of research today, and we're anchoring it with a really comprehensive end-of-day market report.
Right, the bulls, bears, and the bell report.
Yeah, that's the one. It captures the closing action of Thursday, August 6th, 2026.
And, it is a phenomenal data set to dig into, primarily because the surface level numbers are they're masking a tectonic shift happening underneath.
And that is exactly our mission today. We're going to, cut through the mundane index numbers to unpack this massive wait-and-see macro environment that's just paralyzing the broad market right now.
Right, the broader market is just kind of holding its breath.
Yeah. And we'll analyze the ruthless post-market capital rotations. We're talking institutional money, aggressively punishing legacy ad tech while, completely rewarding real AI infrastructure.
Which is a huge narrative shift.
Definitely. And finally, we will arm you with the exact metrics you need to watch when the opening bell rings tomorrow.
Because if you just looked at the major indices today, you might think the entire financial sector just took an early weekend.
It really looked that way. Let's run through those closing numbers to set the scene for everyone.
Go for it.
So the S&P 500 finished down just 0.18%, landing at 7,709.96.
Barely a scratch.
Right. The Nasdaq was essentially flat, shedding a microscopic 0.06% to close at 26,348.35.
Right.
And the Russell 2000 was down 0.60% to 3,000.15. And the Dow Jones actually took the biggest hit, down 0.85%, dropping 464 points to close at 53,885.10.
It was just a collective algorithmic shrug during regular trading hours.
Totally. But let's go back to that contradiction I mentioned at the top, because this is where the underlying story really begins.
The VIX and the oil divergence.
Yes. I'm looking at two specific metrics in this report.
Yeah.
The VIX, which measures expected market volatility.
It's basically Wall Street's fear gauge.
Exactly. It dropped 4.2% today, down to 15.81. So that suggests traders are relaxing, right?
You would think so, yeah.
But simultaneously, Brent crude oil jumped 4.0% to $79.30 a barrel, which historically usually indicates impending chaos.
Right.
So how can fear be dropping while oil is spiking?
Right. Well, we're looking at a classic geopolitical tug of war here between the equity traders and the commodity traders.
Okay, unpack that for me.
So the report highlights some really significant messaging coming out of the political sphere today. Specifically, President Trump and Vice President J.D. Vance are telegraphing that a deal with Iran and Oman to reopen the Strait of Hormuz is currently at the final and best offer stage.
Okay, wait, real quick, before we unpack the market reaction to that, I just want to make something very clear to everyone listening.
Oh, absolutely.
We are strictly reporting the messaging from these political figures exactly as it is outlined in our source material.
Right, we're just looking at the data.
Exactly. We aren't endorsing any viewpoint, any policy, or, taking any political sides here at all. Our sole focus here is analyzing how trillions of dollars in global capital are reacting to this specific news.
And that is a crucial distinction to make. The market's reaction is entirely devoid of politics. I mean, it is purely mathematical.
Yeah.
The broader equities market, which is what drives the VIX, is pricing in a massive geopolitical de-escalation based on this messaging that a deal is close.
Because if the Strait of Hormuz is secured, that's a huge deal, right?
It's massive. It's a massive choke point for global shipping. If that anxiety lifts, shipping costs drop, inflation cools, and so naturally, the fear gauge falls.
Okay, but the energy traders, the ones buying up Brent crude, they clearly aren't buying the de-escalation narrative.
No, not at all, because the oil market is inherently tied to immediate physical supply chains.
Right.
Equity traders, they can afford to be optimistic about a final offer. But energy traders, they know that the term final offer is a total double-edged sword.
Like it's make or break.
Exactly. If those talks stall for even a moment, or if the offer is rejected, diplomatic channels just completely break down.
Which would...
We would see an immediate catastrophic supply shock. So that 4% jump in Brent crude, that is an aggressive hedge. The commodity market is paying a premium just in case this Hormuz Hail Mary doesn't land.
Okay, let's unpack this. The broader stock market is ostensibly calming down because they believe a geopolitical resolution is imminent.
Right.
But we aren't seeing a massive rally. Like we just said, the indices were flat or red. So if the geopolitical weight is supposedly lifting, what exactly is the market still holding its breath for?
Because of a massive domestic hurdle that's arriving tomorrow morning, we are standing on the edge of what macro analysts are calling the jobs cliff.
The jobs cliff.
Yeah.
Okay, tomorrow at 8:30 a.m. Eastern Time, the July non-farm payrolls drop.
Yep.
And our report shows the consensus expectation is 86,000 new jobs added, with unemployment holding at 4.2%.
That's the tightrope.
But wait, 86,000 jobs in a labor force of hundreds of millions? Why is that tiny, super specific number the trigger for a potential market panic?
Well, it all comes down to the math of population growth, just to absorb new entrants into the workforce. So, recent graduates, immigrants, people returning to work after break. The U.S. economy actually needs to create roughly 100,000 jobs a month just to break even.
Oh, wow. Okay, so when consensus drops down to 86,000,
We are mathematically losing ground. It means the unemployment rate is going to face severe upward pressure.
which directly threatens this entire macroeconomic soft landing narrative we've been hearing about for months.
Exactly. For the last 2 years, the Federal Reserve has been walking this crazy tightrope, trying to cool inflation with high interest rates without, triggering mass layoffs.
Right.
So if tomorrow's number comes in at, say, 40,000 jobs, or worse, if it prints negative, the market will instantly determine that the Fed kept rates too high for way too long.
And the narrative violently pivots from a soft landing to a hard recession.
Exactly.
Well, that perfectly explains the acute anxiety we saw in the industrial sector today. I mean, the Dow dropped 464 points.
Yeah, it was ugly.
And our report notes that Honeywell Aerospace, ticker HONA, was the primary culprit. They cratered 19.2% after missing earnings and revenue targets.
Right.
But I've got to ask, how does one single company drag the entire Dow down so heavily?
It is a really weird quirk of how the Dow Jones Industrial Average is actually constructed.
Okay.
Unlike the S&P 500, which is weighted by total market capitalization, like how big the company is, the Dow is a price-weighted index.
Wait, price-weighted. What does that mean in practice?
It means a stock's influence on the index is based entirely on its price per share. Honeywell is a very high-priced stock.
Oh, I see.
Yeah, so when it loses nearly 20% of its share price in a single day, it just rips a massive mathematical chunk out of the Dow index, completely regardless of the company's actual size relative to, a giant like Apple or Microsoft.
Ah, okay. And the reason Honeywell's misrattled investors so badly today is the timing.
Oh, 100%.
Like, if a massive foundational industrial supplier is seeing their revenue dry up literally the day before a critical jobs report, it acts as a very grim leading indicator for the broader economy.
Yeah. The legacy markets look at Honeywell as proof that the economic slowdown is already here.
But it's interesting because that ravenous institutional demand isn't entirely disappearing. It is just becoming incredibly selective about where it parks its money.
Very true.
Because while legacy aerospace like Honeywell was dragging down the Dow, there's a totally different aerospace story in our sources today that just completely defied gravity.
SpaceX.
Yes, let's look at SpaceX, ticker SPCX. They saw shares rise 2.5% to $110.92 during regular trading today.
Which is frankly astonishing when you consider the structural headwind they face today.
Yeah, this is the puzzle I want to break down. According to the report, 900 million SpaceX shares became eligible for sale today due to a lockup expiration.
Yeah.
And for anyone unfamiliar, when a company goes public, early investors and employees are usually locked up, right? They're forbidden from selling their shares for a set period to prevent the stock from completely crashing.
Exactly. It
Yeah.
stabilizes the stock post-IPO.
But when that lockup expires, millions of shares just flood the open market.
It is a massive instantaneous influx of supply. And, basic economics dictates that if supply skyrockets and demand stays the same, the price has to plummet.
Right. It's like opening a massive dam expecting the valley below to completely flood.
Yeah.
But instead, the ground is so parched that it instantly absorbs millions of gallons of water without leaving a single puddle. The institutional demand for SpaceX soaked up 900 million shares without dipping the price. How is that even possible?
It really just speaks to the absolute desperation for high-quality growth assets right now.
Wow.
The report cites Morgan Stanley analyst Adam Jonas, who explicitly framed this massive lockup expiration as a rare buy-the-dip opportunity for institutions who just couldn't get enough allocation during the IPO.
So Wall Street wasn't afraid of the new supply at all.
Not even a little. They were waiting with open arms to absorb it. The demand side was so ferocious, it actually drove the price up 2.5%.
That is wild. And it proves there is still massive capital in the system.
Oh, absolutely.
But the post-market action shows us that this capital is becoming utterly ruthless. Which brings us to the day's biggest warning sign.
Here we go.
During regular trading hours, a company called AppLovin, ticker APP, plummeted 19.6% on mixed results.
Yeah.
Why is a mid-sized digital company the canary in the coal mine for what happened after the bell?
Because AppLovin operates in the ad tech sector, and advertising budgets are the ultimate leading indicator of corporate anxiety.
Right, because it's discretionary.
Exactly. When macro fears rise, like the fear of tomorrow's jobs, cliff marketing is the very first discretionary expense that chief financial officers just immediately cut.
So when AppLovin dropped nearly 20% during the day,
It proved that those B2B marketing budgets are shrinking rapidly. It totally foreshadowed the absolute bloodbath waiting for the rest of the sector after hours.
and bloodbath is really the right word. Let's look at this post-market reality check. The Trade Desk, ticker TTD, is an absolute giant in digital advertising.
Yeah.
And they cratered 23% after the closing bell. They suffered a double miss. Earnings per share, which is essentially a company's net income divided by its outstanding shares, a key metric of profitability, came in at 34 cents against an expected 40 cents.
Ouch.
And revenue was $715 million against an expected $751 million.
A double miss is always bad, but for a high valuation growth stock like the Trade Desk, it was their forward guidance that triggered the 23% collapse.
The guidance, right.
Yeah, they're predicting third quarter revenue of $650 million, but analysts were expecting $805 million.
Wow. That is a devastating downward revision.
It confirms the canary in the coal mine, right? Corporate America is aggressively pulling back on ad spend.
But this isn't just a story about ad tech failing. It's really a story of where that capital is rotating to.
Exactly.
Because while the Trade Desk was bleeding out, Cloudflare, ticker NET, soared 15% after hours.
Just a totally different trajectory.
Right. They beat on EPS, 29 cents versus 27 cents. They beat on revenue, 696 million versus 665 million. And unlike ad tech, Cloudflare actually raised their full-year guidance to $2.87 billion.
This contrast is the crux of the entire after-hours narrative today.
Okay, tell me why.
Capital is fleeing discretionary software and pouring straight into mandatory infrastructure. Cloudflare CEO, Matthew Prince, highlighted record growth in a very specific segment, which he called Agentic AI infrastructure.
Okay, I want to push back on that term for a second, Agentic AI. Is this just, the 2026 version of a company putting .com in their name in 1999 just to juice their stock price? Or do Cloudflare's revenue numbers prove that this is a real structural shift in how computing is actually happening?
It is a fundamental structural shift. I mean, if we look back at the AI hype phase of 2024, the focus was entirely on large language models, right?
Like chatbots.
Exactly. Chatbots where a human types a prompt and the AI generates an answer. That was the hype phase.
Right.
But we have now aggressively entered the utility phase. Agentic AI refers to autonomous agents.
So software acting on its own.
Yes, software that doesn't wait for a human prompt. It takes actions, it talks to other AI agents, and it runs continuous multi-step workflows entirely on your behalf.
Okay, so like an AI agent booking a complex supply chain route, interacting with the vendor's AI agent to negotiate a price, and then just executing the contract without a human ever even touching a keyboard.
Precisely. And think about the compute power that requires. Instead of one human making one API call to a server, you have thousands of agents making millions of continuous automated API calls to each other.
Wow, yeah, that scales incredibly fast.
It does. And Cloudflare provides the underlying cloud network and edge security infrastructure that makes those highly complex machine-to-machine interactions run quickly and securely.
So the market is aggressively rewarding companies that enable this agentic-first model because it drives immediate, measurable productivity for businesses.
The hype is over. The utility era is officially here, and capital is just ruthless to those who can't prove their immediate value. They are dumping ad tech to buy AI infrastructure.
Which brings us to a massive paradox in the data today.
Oh, the consumer numbers.
Yes. If B2B companies are slashing advertising budgets in fear and legacy industrials like Honeywell are cratering, you would logically expect the average consumer to be really tightening their belts.
You would expect consumer spending to be absolutely in the gutter right now.
But the after-hours earnings in the travel sector tell a completely different story.
It's so weird.
Look at Airbnb, ticker ABNB. They surged 10.5% after hours. They beat their EPS at $1.37. They beat revenue at $3.61 billion. And they actually raised their 2026 outlook, specifically citing accelerating demand in the U.S. and Europe.
It completely defies all the industrial gloom we were just talking about.
And they aren't an outlier either. Lyft, ticker LYFT, is up 6% aftermarket. They beat revenue at $1.84 billion and reported a record 30.5 million active riders.
That's huge.
Even legacy media saw a consumer bright spot today, with Warner Brothers Discovery, ticker WBDD, gaining 1.5% during regular trading on strong quarterly figures.
This raises a fascinating question about our current economic reality. We have a severe disconnect between Wall Street and Main Street right now.
What do you mean by that?
Well, Wall Street algorithms are hedging aggressively for a macro slowdown, right? And they're bracing for this jobs report tomorrow. But Main Street, consumers are still booking European vacations on Airbnb and hailing rides at absolute record levels.
But how is that sustainable? I mean, how can the broader market be so terrified of a recessionary jobs report tomorrow when millions of people are clearly still out there traveling and spending heavily?
It highlights a deeply bifurcated economy.
Okay.
The labor market might be cooling at the margins, which is what terrifies the algorithmic traders who trade strictly on macroeconomic data.
Right.
But household balance sheets, particularly for the middle and upper middle class demographic that's, driving travel and ride shares, they still have significant wealth effects from the stock market and home equity.
Oh, I see.
They haven't gotten the memo that they are supposedly in a recession, so they are continuing to drive massive corporate earnings in these experiential sectors.
Wow. It really is a truly bifurcated day. A quiet, anxious surface level across the major indices, masking these violent, sector-specific rotations beneath. Ad tech getting completely crushed, AI utilities soaring, legacy industrials missing, and consumer travel booming.
Which means it is a stock picker's market right now, entirely divorced from what the broader index is doing.
Absolutely. Which brings us to the most important part of this deep dive. Our mission is to arm you for tomorrow.
Right.
So based on the analysis in this report, what is the actionable watch list? What are the 3 specific metrics our listeners need to be watching when the sun comes up?
Okay, number 1, you have to watch the clock for 8:30 a.m. Eastern Time. That July non-farm payrolls report is the undisputed macro trigger.
That's the 86,000 number, right?
Exactly.
Yeah.
Watch that consensus number. If we hit it or beat it, the soft landing narrative survives, and we will likely see a relief rally.
But if we miss it?
If we miss it badly, the Sam Rule recession fears take over completely, and you really need to prepare for a very volatile Friday.
Okay, got it. And the second item on the watch list?
The opening bells for Cloudflare, Airbnb, and the Trade Desk.
Because of the after-hours action?
Yes, we saw massive double-digit moves in after-hours trading. You need to watch the first hour of regular trading tomorrow to see exactly how institutions position themselves.
To see if it holds up.
Right. Do they defend those massive moves, or do we see mean reversion?
And for those newer to the mechanics, mean reversion just means institutional investors deciding to immediately take their profits after a huge spike, which effectively sells the stock back down toward its historical average.
Exactly. If Cloudflare holds its 15% gain through the morning, it proves the pivot to AI utility is a permanent institutional rotation, not just some knee-jerk reaction.
Awesome. And the final thing to watch.
Brent crude prices. Keep a close eye on the geopolitical wires regarding the Iran and Oman shipping deal.
Okay.
Watch to see if Brent crude retreats back below $75 a barrel. If it does, that confirms the commodity market finally believes the political de-escalation is real.
And if it doesn't?
If it stays near $80, it means energy traders are officially calling the politicians' bluff.
Wow. It is going to be an incredibly telling day for the global economy.
Yeah.
As we wrap up this deep dive into the bulls, bears, the bell report, I want to leave you with a final thought to just mull over.
Sure.
We spent a lot of time analyzing the brutal transition from AI hype to AI utility
Yeah.
and how ruthlessly the market punished companies that couldn't prove real productivity today.
It is a capital rotation that will define the rest of the year, honestly.
So tomorrow, I want you to look at the software tools you use at your own job every single day. Look at the screens you stare at. Which of those tools are actually doing the work for you, acting as autonomous agents, executing workflows, and saving you measurable time?
Right.
And which ones are just legacy platforms wearing a shiny new AI name tag just to look modern? Because if today's action with Cloudflare and the trade desk proved anything, it's that tomorrow, the stock market is going to price those two types of companies very, very differently.
Yeah. The utility era waits for no one.
It certainly doesn't. Thank you so much for joining us on this deep dive. We'll be back next time to help you cut through the noise and understand exactly what is moving the markets. Until then, keep questioning what's beneath the surface.